Well, look, we've kind of been in that camp for a while. We were waiting for some event or something to kind of tip us over a little bit on equity valuations. As you know, we've been on this show several times talking about the most vulnerable parts of the market being growth stocks, small caps. And the reason being is that they're the most overvalued.
Tech.
Yeah, tech is part of growth for sure. So look, the bottom line is that we got this sort of exogenous shock in rates 2 weeks ago, which, by the way, we didn't really see. And we have to ask ourselves, why did that happen? We think it happened more because of a funding deficit than, say, inflation or growth being better. Okay, and that funding deficit is happening for two reasons. A, we know the fiscal budget deficit is going up a lot, okay, and that's unfunded. But what happened on October 1st is that the Fed actually increased its balance sheet reduction. At the same time, the ECB started tapering for the first time, and throwing the fact that stock buybacks are now in the quiet period, and you just have a liquidity problem. So rates shooting up well above 320 tips us over on valuation, and that's all it took. And then once it gets going, the momentum kind of goes the other way.
All right, Steve, did we tip over too far? We got pretty oversold yesterday, no? I mean, are you feeling as though we're closer to the end of this, or is this just what feels like the beginning or close to it?
I still think there are a number of areas in the market that are overvalued. I mean, you know, I've looked at some names in the growth names, and you've talked about them, that are very overvalued. And if you hold this level on the 10-year, if you hold this level on rates, I think you can make a reasonable case that you should be in 10 years.
And let's also
change. So
rates coming down.
Rates are coming down.
Rates are coming down.
Up. It's a safety trade, and Mike's right, and I spoke about it yesterday. Rick Reeder spoke about it. It was a supply issue. It was a funding issue. We're over that with the 10-year for now, and I don't think that the Fed is going to increase their targets in terms of one more this year, three more next year, at least verbally, until we start seeing more inflation, given where the market is. So look, I traded some stuff today. I think it's a good trading environment. Got in, got out very quickly, you know, hit on 3 of the 4. And I'm not just willing yet to add more exposure to the exposure I took off.
So is this, Jim, just a run-of-the-mill correction? Corrections come and go, as Larry Kudlow has said, others have said. Listen, this is just a correction.
I'm going to take your bait.
They never feel great.
Scott, yes, it is. And exactly. They never feel great. It always feels like something worse. But, you know, something worse would be a bear market. And I just don't think you can get that if you don't have a recession here in the U.S. You're pretty far from that. Now, look, we're talking about interest rates. That's the appropriate thing to talk about. There's also this other smaller thing of a China trade war and the potential that they'll let their currency devalue more than was thought. The ripple-on effects through emerging markets, those need to be sussed out over the next few months, but they won't before the election. In terms of what do you do here, again, to your point, Scott, this is not a crisis, okay? Use the volatility to your advantage. Like Steve, I sold some stocks yesterday. Greenbrier had a tremendous run. Time to take profits. Mylan, the pharmaceutical company, had not done so well. Time to get rid of it. Why? Because there are opportunities being created in these volatile times, and you got to be ready to pounce on them. Also, like Steve, this is rare I'm agreeing with him this much. I don't need to pull the trigger right now. I can wait a day or two and let this volatility work its way through.